Of course, as you've just heard, there's a lot more data coming in now pointing to the damage that is being done by Kenya's rate caps. Interbank lending has fallen by about a third. 6 small banks, which account for roughly 7% of sector assets, are struggling with non-performing loan ratios of over 20%, while the average sector, the sector average was just about 9% by the end of October. Now, private sector credit growth, of course, has fallen to levels not seen in nearly a decade, at 4.3% in December. Earlier on, I spoke to Anzetse Were, one of the economists who had argued against these rate caps. I asked her at the time if the data available now vindicates her position.
I absolutely do, because I think the people who crafted that whole process were just taking advantage of an election year coming up and came up with very populist sort of notions that they knew the public would broadly agree with, even though the public did not understand the consequences of them. And I think that's what we're seeing now. There's a contraction in liquidity going on in the markets. I've been traveling around the country in different counties for the work that I do, and I talk to SMEs, and what's happening is that, of course, either they don't get the credit lines they used to, or if they do, they're at a much smaller scale than previously was the case. So I think even though people are saying it's too early to tell, I think it's becoming very clear there is a contraction in liquidity, and I think this is part of the problem people are having, this year, where they feel that money is in scarce supply.
Right. There was this pretty interesting line in the Monetary Policy Committee's report when they met on the 30th, and they said there's insufficient data to actually determine whether or not, to determine what the effects of the rates cap are. I mean, that sounds pretty incredulous. How can a regulator say there's not enough data?
Well, I think it's just part of the data problem that we have. But I think part of what informed that monetary policy decision is because there is inflationary pressure coming from the droughts, which will not only increase the cost of food prices, but the cost of electricity as well. So there's that inflationary pressure, but I think that's being counteracted by this contraction in liquidity that was engendered by the interest rate cap. I think the data problem is a real one, and one of the demands I have as a Kenyan citizen is that the government must monitor the impact of this interest rate cap on the economy and on the banking sector. I think if we don't demand that, then they can claim whatever they want in terms of it worked or it didn't work. So I think it's time for Kenyans to say, well, this is an opportunity to learn about how interest rate controls operate in the 21st century in Africa, in a fairly diversified economy, and then draw those lessons. But I'm still of the fundamental view that lending has declined significantly.
Speaking of that, again, going back to that data issue, I mean, the way this reports are usually put together, it's IMF comes into the country, they meet Treasury guys, central bank, private sector guys, and one of the lines that came out of this was that 6 Kenyan banks, which account for about 7% of banking sector assets, have non-performing loans over 20%. Yeah. That's a scary number.
It is a scary number, and I think we need to appreciate why banks had such high interest rates to begin with. We have an asymmetry of information problem where banks cannot assess the credibility of borrowers, and that's why they used to buffer their risk by tending toward the higher price point. So you can't really tell banks to respect a cap and continue normal lending when that information, the credit worthiness information, is not available. I'm not surprised that the NPLs are rising, because the irony of this whole situation is that although the interest rate cap was aimed to make credit more affordable, it's still too expensive for most people.
At 14%?
Yeah, at 14%, it's still too expensive. So it's not as though, people can suddenly, borrow and make money and benefit from low interest rates. If you talk to the average SME, where you're talking about interest rates that are at 1-2% in other parts of the world, the sort of performance their business has to be undergoing to repay, even at 14%, is quite aggressive. So I think the whole intention of the interest rate cap was misinformed, and clearly even that lower rate that was meant to engender higher borrowing, that intellectually doesn't make sense.